In the past, they say, when you get a financial crisis, everybody rushes for dollars. Not quite true. What they rush for is dollar liquidity. And there's a big difference between having dollar liquidity and owning loads and loads of illiquid dollars. Now, the illiquid dollars are in stocks, they're in US treasuries, and so on. They can easily be liquidated. But think what happens to the securities markets, financial asset values, if you get that sort of selling, and the selling being followed through by the dollar itself being sold, then you can see quite quickly how the pressures are going to be for rising interest rates rather than falling rates. The record level of longs held by the non-reportables was about 158,000 contracts. That was recorded on the 24th of March, literally a day or two after the bottom. So this is smart money. The smart money is in the non-reportable category, and they bought the market right at the bottom of that smash. They are close to record long again, which, if what I say is valid, that this is smart money, tells us that the squeeze is about to enter a new phase.
Welcome back to Liberty and Finance and Reluctant Preppers. We're delighted to have this returning guest who's very well respected and highly anticipated by our viewers. Alasdair Macleod is the head of research at goldmoney.com. He joins us this Monday, August 3rd, 2020. Alasdair, thanks for joining us.
Thank you for asking me, DK.
We cannot miss the opportunity to check in with you on a major analysis that you shared in the last time we spoke with you and in some of your writings at that time, which was way back in the early parts of July, about a potential banking crisis yet in the month of July, and also looking forward to a fiat currency crisis by the end of this year. We passed the end of July without a complete collapse of the banking system, at least as far as we know. I haven't checked this morning with my bank, but we really would appreciate if you could inform us about what you see now from the current vantage point of the ground that we've covered over the past several weeks, whether that has further confirmed your strong concern about the imminent probability of a crisis in the banking system, or if there have been any mitigating factors that emerged that have moderated your stance on that. Then we'll move forward into some viewers' questions.
Yeah, sure. Yes. In one sense, I'm glad we haven't had a banking crisis in July, but the danger has not been, if you like, dismissed. It's still there, very much so. And I think that since we last talked, there has been more and more evidence of the economic damage that has been done, directly from the COVID-19 lockdowns. And also, as a result, and this is something which nobody is really talking about, but we've discussed this, the global economy was already turning down, and we saw the effect on banks back in last September when they had to go running to the Fed for liquidity. So in a sense, you could say that the banking crisis started back in September because with banks having to go to the Fed for liquidity, that was, if you like, the beginning of putting everybody on notice that things aren't quite as they should be. The banks are desperate to reduce their balance sheet exposure because they've moved from greed to risk. And I think I've made this point before. We are seeing a crisis developing in a different sense in the gold market. Despite every attempt to try and talk it down, there was the early attempt back in early March to reduce the number of outstanding contracts, to allow the bullion banks in the form of swaps, designated as swaps on COMEX, to recover their short positions. They are now more short than they were then in terms of value, slightly fewer contracts, but of course the price has risen from, it was $1,700 before they smashed it. It's now $1,900. They smashed it down to $1,450. It didn't stay there very long, just a matter of days, around about the 20th to the 23rd of March. This is a crisis for the bullion banks because if you look at the other side, the speculators side, as it were, you've got the managed money category. They've been taking profits, yet still the swaps are short. They've managed to close just a few shorts, but that's about it. The monetary value of their shorts has increased because the price has increased. So, and the point about the managed money category is that this is basically hedge funds. And hedge funds chase trends. They buy gold because they're selling the dollar and vice versa. They're not in there to take delivery. They're in there for a quick trade, in and out. Tomorrow they look at something else. So when they build up a position, they are very vulnerable to the change in trend, which is what the swaps actually manage to engineer every time, which is why the hedge funds always get wiped out. They're not in there now. The hedge funds have less of an exposure than the non-reportables. The non-reportables being basically the ones which don't fit into the other category. The other three categories: producers and merchants, swaps, or managed money. Those non-reportables are now larger. I think it's something like 152,000 contracts on the last commitment of traders figures, compared with the hedge funds, who are somewhat below that. And this is interesting because if you look at the data, you go back and see the data, when that smash down occurred, the record level of longs held by the non-reportables was about 158,000 contracts. That was recorded on the 24th of March, literally a day or two after the bottom. So this is smart money. The smart money is in the non-reportable category, and they bought the market right at the bottom of that smash. They are close to record long again, which, if what I say is valid, that this is smart money, tells us that the squeeze is about to enter a new phase. Now, we've discussed before how the price of gold is likely to go up and up and up. Why? Because what's happening is the purchasing power of the dollar is going down and down and down. And we've gone through the reasons for this. The Fed is printing money at an unprecedented rate and will continue to do so. And the commitments that it has down the line are enormous. Nobody talks about supply chains anymore, but they're still there. They need backing up. They need financing. You have got the whole paradigm of financial asset values, which the Fed is trying to support. It's trying to support it because if it doesn't do it, two things happen as far as the Fed is concerned. The budget deficit can't be financed at anything like an affordable level. That's the first thing. And the second thing is the Fed is sold on the idea that you have high stock prices, you have a wealth effect, which basically means that we all feel happy, wealthy, and go out and spend. I mean, they've stretched that one to an extraordinary limit. You can't have a non-financial economy with businesses going bust in record quantities, records which are going to be broken next month and the month afterwards as well, and have the Dow Jones, the S&P 500, sort of going up like it's a wonderful bull market. This is complete nonsense, a complete dislocation. That will end. So coming back to the question about the failure of the banks, that's still there. I did a piece actually on the European banks since we last talked. That was released last week. And it's just amazing how much in the way of bad debts have been shoveled into the Target 2 system by the Italian banks and the Spanish banks, which they do basically by going to their national central banks and instead of paying through the Target system, borrowing the money in order to do it. So that means that you end up with negative balances on those two central banks. They're not the only two, but they're the real guilty parties. And poor old Germany is now owed something like €1 trillion. I mean, it's very close to €1 trillion. And there's no sign of that. That's never going to come back. And so the system there is broken. It's a settlement system which is broken, and it's a settlement system which is hiding the bankruptcy of the banking systems in the weaker countries, what we used to call the pigs: Portugal, Italy, Greece, and Spain. So the problem has not gone away. If anything, has got worse. There is the possibility that central banks are sitting on the problem and not allowing this to get into the public domain. But if that's the case, they can only do it for a very short period of time, because it won't be very long before we start noticing the flight of money from the weaker banks. And by flight of money, I mean depositors, holders of bank bonds in particular. When we begin to see the run on that, then I think that's going to be curtains for the system. There is also another problem which is beginning to rear its head a bit, and that is the banks that do business in China. We've got two in this country which are major: Hong Kong Shanghai Banking Corporation and Standard Chartered, or I think they call themselves Standard Bank now. They are very much tied into business in Eastern Asia, and HSBC in particular. I mean, they were founded in Shanghai a long time ago, and their share price has come under some considerable pressure recently. And it's worth watching these things. Look at the bank share prices, see how they go, see how they move. Not so much the American ones, because the relationship between price and book value is actually sort of more or less one-on-one. But if you look at the Europeans, price to book value, 20%, case of SocGen, the French bank. Barclays are something like, 25, 28%, something like that. Deutsche Bank, similar. I mean, when the market values the equity in a bank at only 20% of its book value, then the market is telling you something. Don't ignore it.
You mentioned several things in passing there that I wanted to follow up on. First of all, you talked about the brutal downturn in the real economy. You said each quarter, each month, we're going to be setting new records of business closures, that sort of thing. You retweeted a tweet yesterday or the day before by a gentleman who's involved in financing of small businesses, specifically bank financing of like franchises, that sort of thing. He mentioned like Jimmy John's Sandwich Shop and a wide variety. Sounds like significant breadth and scope and range and diversity of different types of small businesses. And he had some dire reports on the just complete drying up, just a drought of funding from banks to small businesses. Can you talk about what you tweeted that you're seeing the same thing. What are you seeing? What does it mean? What is its impact likely to be?
Well, the gentleman was absolutely right. I mean, he was talking from the experience. The fact is, banks do not want to lend any money. Their balance sheets are already very highly geared. Now we have COVID-19. From a banker's point of view, this is just added risk, and the risk is just mounting so much. Now, it's quite difficult to say, turn around to General Motors or someone like that and say, I'm sorry, we're not lending you any more money. But it's a lot easier to do it with an SME, a small to medium-sized enterprise, which is what the gentleman was saying. He's finding that the banks actually are just twisting round. If you get as far as filling out a form, they then send further forms, and eventually the answer is no. It's quite clear they do not want to lend any more money. And, of course, SMEs are the easy target. I mean, we've talked about this before. The credit cycle has turned. The bankers are no longer greedy for profit. They're now fearful of losses. And that is actually what it's all about.
The other thing that you talked about was near zero interest rate policy by the Federal Reserve and other central banks. We have a question related to, and you mentioned the implications of that on financing the debt. Victory CSA says, you have previously commented that despite the Federal Reserve's best efforts to suppress interest rates to around zero, that you expect interest rates to rise to the 4 to 6% range by the end of the year. In your opinion, what would be the catalyst that forces interest rates back to a more normal range of 4 to 6%?
Basically, loss of purchasing power of the dollar. And I think initially that will come through with foreigners selling. I mean, since we last talked, we've seen the dollar slide on its trade weighted. It's recovered a little bit this morning on as we speak. But basically, the foreigners own, so far as we are aware, a figure like $27 trillion of securities, treasury bills, and bank deposits. That is a huge number. 27 trillion is well in excess of US GDP. 2019 GDP, I think, was in the region of about 20.5 trillion. They've got 27 trillion. Now, if you can imagine that the world is turning down in terms of economic activity, then governments and banks have too many dollars for the future. I mean, if we were on a wonderful growth path and that was going to continue and continue and continue, you would hold more dollars because you expect more trade in the future. Now you expect less trade in the future. What do? You sell your dollars. Now, people have been confused on this because in the past, they say, when you get a financial crisis, everybody rushes for dollars. Not quite true. What they rush for is dollar liquidity. And there's a big difference between having dollar liquidity and owning loads and loads of illiquid dollars. Now, the illiquid dollars are in stocks, they're in US treasuries, and so on. They can easily be liquidated. But think what happens to the securities markets, financial asset values, if you get that sort of selling, and the selling being followed through by the dollar itself being sold, then you can see quite quickly how the pressures are going to be for rising interest rates rather than falling rates.
You've also talked about, speaking of the dollar, Heike Frost asks, Alasdair, you said there's a good possibility of a dollar/currency crisis by the end of the year. What do you say to those who see deflation for the next 1 to 2 years and that the dollar is likely to remain in a trading range?
You have to be quite careful what you mean by deflation. The deflationary pressures from the banks are enormous, and we don't actually know that the Fed will be able to overcome them as such. And by that, I mean somehow bypass the banks and get the money to the people like we were talking about, the SMEs and the real depth of the economy. I think that's going to be very difficult for the Fed. So in that sense, we have a deflationary environment. But actually, the background is inflationary because the central bank will always ensure that there is adequate liquidity for the economy. They will always ensure that money is injected into the economy through the government by financing the budget deficit. So you've got to be slightly careful about what you regard as deflationary. It's not the whole economy by any means. It's just one sector of it, which is creating enormous difficulties, admittedly. But the response to that will be yet more monetary inflation from the central bank. And the effect on currencies, the reason I see currencies really facing almost their terminal crisis fairly shortly, really, this year, is that the Fed in particular has set its stall out on preserving financial asset values, just as I was saying just a moment ago. When they fail, the dollar will fail. The two things are linked together. They're tied, bound, hand and foot. One goes, they both go. Now, if you look at the value of financial assets in America at the moment, I think you'd be quite hard pushed to produce a cohesive argument that they're perfectly all right and will continue to be so. It looks to me like the disaster, if you like, that this is turning out to be is becoming more intense by the day. And frankly, if the dollar disappeared as a workable currency by the end of this year, I would not be surprised.
People are many asking this question. I'm actually going to take a representative question, but it represents a whole half a dozen or so. They're watching these low interest rates, which have to some extent lowered the available retail interest rates for house mortgages, residential home mortgage loans. And people are wondering, okay, we're having record low interest rates on mortgages, which is quite attractive to potential buyers, and yet they're very concerned about the potential of a real estate bubble collapse from the pricings that have been supported by that low interest rate environment for the past decade or so. Folkvar says, what do you think about getting a mortgage at this time in the UK? I know we're not giving individual financial advice. We don't know anything about these individuals' situations, but this is a general question many people are looking at is, should they jump in on these low mortgage rates, or should they hold out because this mortgage interest driven real estate pricing bubble is likely to pop?
There's several parts to the answer to this. I think if you look at what's likely to happen to house prices, in real terms, I would expect them to fall. One of the bits of good news is that housing is not a financial asset. The problem with housing is that it is financed by credit, and the availability of credit will to a large extent determine future prices. So when I look at the availability of mortgages and so on and so forth in this country, they're being offered to fewer and fewer people. I mean, there was a thing in the paper this morning about one of the big lenders here called Nationwide, who's no longer lending money or is going to restrict its lending to people who are provided money by their parents as part of the deposit. Now, this is complete nonsense. I just don't understand the logic of this at all. But you have a market where the lenders are, I think, trying to reduce their exposure, particularly when it comes to loan to values of, say, 80% plus. Now, that is going to affect the market, obviously, and I think that prices are likely to fall, but it's not going to be an even fall. I mean, what we're seeing at the moment is prices in central London, I think, are almost in a state of collapse. Prices out in the country seem to be holding up quite well. I mean, where I live, which is in the West Country, prices seem to be rising, and there is a shortage of houses, if you like, for the buyers who are all coming from places like London, Birmingham, Manchester, and so on, because they don't have to commute to the office daily anymore. They can work from home. This has become a lot more accepted, a lot more acceptable. So you do have these shifts, if you like, in demand. But overall, I would expect that house prices in real terms will go down very substantially. But you have to live in your house. You have to live somewhere. And it's wrong to look at it as a financial speculation, if you like. I think that is always a big, big mistake. It's a mistake that people in this country make because they've progressed. They've ended up with a nice house basically by being clever in their buying and selling of houses. And they get to the stage where, they've then got quite a nice house. And when they retire, hopefully they get, they can sort of get some sort of payoff or bonus or something. And, you can pay off the mortgage. Brilliant. That's in theory how it works. But we're going through these extraordinary times. And what I say about the dollar might not exist at the end of this year. It's possible also that could be true for sterling. Our government here is behaving very socialistically, doesn't seem to worry at all about expanding the quantity of money to finance the government deficit. I mean, they will claim that it's not doing so. They will claim that there's a greater savings rate. I don't think so. I don't think that's right, because the savings rate actually isn't something you can measure directly. There are some people who are putting aside money because they're not spending quite so much. Yes, but generally, they're more than outweighed by people who are going bust because they've got no business. So the situation is not good. And what I would say is that if you do take out a mortgage to finance a house, I would look to finance it at a rate. I mean, if you can get it at, say, 1.5%, 2% mortgage rate, whatever the rate is at the moment, it's something like that, and get it for at least a couple of years. And that should see you through the crisis stage. Because if you don't, when sterling starts going down the tubes and bond yields have to, or in our case, gilt yields start rising, and building societies start having to raise their interest rates, you can see it's going to be absolute chaos. You've got to be able to ride through that. You have got to be able to pay the at least the interest on the mortgage, even if you lose your job. Just continue to do that, and then you should survive it all. So, but property, I mean, it's a very, very changed time. It really is. And you've got to plan to see your way through the crisis. Make sure you can pay the interest. Make sure that the interest is locked in at a nice low rate. That would be what I would do.
Back to the topic of the fiat currency system collapse stage and the banking system collapse, Anna Krzyzelinsky says, if anyone has read the book Dying of Money, Lessons of the Great German and American Inflations by Jens O. Parson, would know that the inflationary collapse took nearly a decade and the horrific impact wasn't really felt by the German people until 1923. So, for you, Alasdair, is the United States at the final stage when the true nature of the hidden inflationary forces will be unleashed in 2020 to the greatest suffering ever experienced by the American people?
That's a very good question. I note that so many things turned on the 22nd to 23rd of March. I just wonder whether that's the beginning of the complete collapse. I don't see this collapse being the same as in Germany. I mean, your correspondent is right that basically Bismarck financed the armament build-up before the First World War. It was all done on the state theory of money. There's a chap called George Knapp who produced the state theory of money with his charter lists, they were called. And following the war, when Germany lost, then obviously the rate of inflation started rising and rising and rising. I'm talking about price inflation, sorry, rising and rising. And then finally, in about May 1923, what happened was that the people in Germany suddenly realized what was happening. They realized it wasn't prices rising, but the purchasing power of their mark, their paper mark, falling. So what they did was they started dumping the paper mark. And that is, I mean, when that begins to happen, basically there is no hope for the currency. It's an irreversible problem. So
I think you mentioned the same mindset shift last time we spoke with you, and people were puzzled by that. But I think it's because we're all just in this trance from childhood on of being mistrained to think of our currency as a store of value, which if we look at it analytically, it's absolutely not. It's not been that.
Yeah.
But just what you just said, it's not, people realize it's not that prices are rising, it's that the currency is falling. And the questions that came after you said that last time was like, well, what does he mean? Aren't those two the same thing? But I think you're getting at, if I'm hearing you, is there's a mindset shift to recognizing that if you assume all along that your currency is a rather stable thing, then you say, wow, it's taking more and more of this to buy that consumer item, then that thing is becoming more expensive or more, something is changing about that thing. But then there's this mental flip when people realize, no, the thing isn't changing. It's that the currency is shrinking away. And the effect mathematically may be the same, but their realization of what is stable and what is unstable shifts suddenly. Is that what you're getting at?
That's absolutely right. And it changes the ordinary person's behavior. And the ordinary person will understand that the currency is going down in value in terms of what it's purchasing. I mean, they will sort of understand that. But for the purpose of a transaction, they regard it as the objective value, if you like, in the transaction. All the change being in the item being purchased or sold. Okay? So, if you and I decide to do something, I mean, I like the sofa that you're sitting on, I say, I'll make you an offer for it. If you agree and you sell it to me, we've got different valuations on the currency. You want the currency more than you want the sofa. I want the sofa more than I want the currency. The
transaction,
okay?
Right. Mm-hmm.
So we can understand that. But for that to actually work, there has got to be a stable, objective view in the value of the currency, even though we have a different opinion on it. Okay? If, on the other hand, items start rising in price and suddenly there's a sort of, if you like, a light bulb moment, and I suddenly realize, do you know what? It's not things going up, it's the money going down. Then that changes my behavior completely. And that's what we're talking about. When the general public finally recognize that point, then the money is doomed. Now, we had this major turning point on the 23rd of March. And I think this situation isn't really like the German one in 1923. I think it's more like the John Law experience in France in 1720. And I think I've said this on your show before, but basically what happened was that Mississippi bubble, it was going along absolutely fine. John Law was, he had this wonderful situation of an asset which he could puff up because he owned the central bank, and he could just print money to buy shares to keep them going up. How different is that from what the Fed's doing? Not a lot. The only difference is that what the Fed's doing and other central banks is a global version of John Law. Come, I think it was 28th of February, he was going to merge his Banque Royale with the Mississippi venture. I think that actually went ahead just a day or two after that, so very early in March. By September, there was value, allegedly, in the shares. They'd fallen from something like 12,000 to around about 1,000 or 2,000. But the purchasing power of the livre in the London market was zero. In other words, the foreign exchanges said that the currency is worthless. You could call the value of the shares whatever you damn well liked, but if the currency is worthless, then it is worthless, full stop. And that happened in 6 months.
Now, exactly what you just described, again, back to that mindset shift, the efficacy, the effectiveness of touting the booming stock markets in the face of a wrecked economy and tens of millions unemployed and half the businesses being failed and all this stuff happening. Yes, but look how great the stock market is doing. Again, similar mind shift. As soon as the common person realizes, I don't care what you say that stock market is, it's just a number you're counting in worthless currency. Is that the similar mind shift you're talking about there?
Yeah, the point is that if you tie the success of your asset bubble to the currency, and you bind the two hand and foot, one goes, they both go, and that's exactly what the Fed has done.
All right.
So I can't see. We'd have to somehow prove that there can be an alternate outcome. I can't see where it is.
History doesn't provide us that. Okay, so let's drill in one last thing then on the currency crisis itself that you see ahead. We've got all kinds of questions, maybe a dozen or more. I'm going to try to condense them down into two primarily. One is talking about, well, they're both asking what's next. If the currency goes, do you go to a basket of SDR type currencies? Do you go to a gold back, or do you go to a crypto system? So could you just give us your view? And I'm afraid because we have new technology on deck, maybe history won't be a perfect guide here, but what do you see based on who you've spoken with and the research you've done of what the most likely outcome for a failed currency is that you see it? What would be next?
Well, you mentioned three possible alternatives. SDR is a basket of fiat currencies. No, they will have gone as well. And I think I'm right in saying also that a condition of the SDR is that gold should not be part of it. It was your country that set up the conditions. The dollar is the reserve currency, full stop. So SDR is not a solution. They will collapse with the fiat currencies. I'll come to gold in a moment. If you look at cryptocurrencies, cryptocurrencies in theory could be a solution. But the problem is that cryptocurrencies can't handle the rate of transactions which a monetary system has to be able to handle. I'm thinking of something like Bitcoin, for example. Using PayPal or Visa or whatever, they do, billions of transactions a minute. It's just open-ended. It's just fantastic, if you like, in that capacity. Bitcoin, you just don't have that ability. You could argue that a currency like Bitcoin could act as a store of value rather than for transactional purposes. But think this one through. If we get to the stage where, I'll come to gold more in a moment, but if we get to the stage where we go back to gold, you're then pricing Bitcoin in gold. Bitcoin then becomes redundant. So as I see it, I can't see where the exit is, if you like, for Bitcoin. The exit for gold, however, is that you spend it. And, it's very easy to produce a gold substitute. The only thing that you must do is to make it credible by putting in a rules-based system so that you can swap paper for coins, for gold coins, on the individual's demand. No conditionality put into this.
Oh, you mean like it used to say, payable to the bearer on demand in gold coin?
Absolutely, yeah. Like you used to be able to do before 1933.
Right.
And we used to be able to do with sovereigns. I mean, it was literally, a sovereign was a pound, and it was interchangeable, literally. I could go to the bank, hand in their paper money, and take out sovereigns. You need to get back to that. But you can't just go back to that and say, suddenly declare new gold standard, so many dollars to the, to an ounce of gold or whatever, or a grain of gold or whatever it is. No, what you've got to do is you've actually got to address the role of government in the economy. Government basically has to back out of the economy. And not only has it got to back out, but it must never run a deficit. Small margin may be, but tiny, and something that varies around naught, not something that varies below naught, if you see what I mean.
Mm-hmm.
If you can do that, you can maintain a gold standard. And your country becomes, and you as individuals become, immensely wealthy over a period of time. And probably not a very long period of time either. I mean, 25, 50 years would see enormous progress. Economic progress, which means technology, it means products for the consumer. It means government butting out. Now, if you can imagine your government doing that, then good luck to you. I can't. So we could end up with a gold standard, but we have to go through the crisis first. And that crisis would have to be so severe, it would have to wipe out completely any concept of macroeconomic theory. Macroeconomics is about aggregates, not about people. It is people who actually make an economy, not an aggregate. That's a very important point to understand. Important also to understand that macroeconomics didn't exist before Keynes invented it. On the back of his general theory, published in 1936. So a lot has got to happen before gold can come in as a proper form of money represented by dollars, pounds, yen, euros, whatever it might be. For them to represent gold, there has to be that underlying background stability. And it means that government's role has to be reduced literally to a bare minimum to ensure law and order, defense of the nation, and virtually nothing else.
Our subscribers are doing backflips at the thought of what you just described, but those of us who've been around several decades are a little bit sobered by the way that history usually plays out when you're telling governments to back out and central banks to cease to meddle and that sort of thing. So Silverweed says, thoughts on an American Civil War, ? Do these transitions ever happen peacefully, or is it almost certain that it would be some major conflagration before we could end up with quote unquote governments backing out of the economy and balancing their budgets and so on?
They can happen peacefully, but they rarely do so. The political strains going through those changes are enormous, obviously. But if you look at Germany in the late 1940s, after the Second World War, the economy minister, Ludwig Erhard, actually had a plan, and he followed it through. He forced it through against the wishes of the military supremos who were running certainly the Germans, the British sector and the American sector. Basically, he turned around and said, he told them that I've removed all restrictions on products. So, people can buy and sell what they want. What? Do you know, that didn't happen in this country until 1953. And we were the winners, for goodness sake. But we had socialism. Ludwig Erhard went back to free markets. And he trusted free markets, and he was right. And the currency became stable as well, stable enough so that Germany could earn, if you like, gold through exports, built up a significant gold position, really through the success of her own economy. And by the fact that people were prepared to save, they were encouraged to save, sort of, encouraged in the sense that the taxman never bothered to collect tax on interest, simply because he knew very well that if he tried to do that, everybody would move their money either into Zurich or into Luxembourg, which is indeed what people did. So there was no real attempt to collect taxes on interest, even though they were set at a withholding tax of about 10%. The same was also true in Japan. The reason they're such strong savers is that they could save tax-free up to a certain level in a post office account. And when they got to the limit in the post office account, they merely opened another one and had another tax-free run, and another and another. And this meant that there was a propensity to save, which meant that the capital was provided for the rebuilding of the economy. And we will be looking at rebuilding our economies in the same way, too. And through the rebuilding of the economy and consumers who were continuing to save, you ended up with the two best economies in the world, really, until Germany went into the euro and Japan had, it sort of encouraged the bubble, if you like, a financial bubble, which collapsed. I can't remember when it was. It was way back, 1980, 1990, thereabouts, something like that. When the Nikkei hit 40,000, it's never been up there ever since. So, but until then, I mean, it worked like a charm. Now, of course, the Japanese are full-blown Keynesians. Germany's lost all her savings to countries like Italy and Spain.
Well, they also made the mistake of
Greece.
storing their gold in the U.S. and asking for it back rather than holding it physically.
Yeah, they got some of it back, not all of it. But no, absolutely.
We're looking ahead, and that's why it gets a little bit foggy in the crystal ball. But people are very appreciative of your very clear-minded thought process that you bring to this, and there are some huge variables ahead and some important precedents we need to be aware of. You help us to stay focused on both of those. We just thank you for joining us again. We've been speaking with Alasdair Macleod, the head of research at goldmoney.com. You publish every Thursday, I believe?
Yes, every Thursday. Yeah. Gold Money Insights. goldmoney.com/insights.
All right. Alasdair, as always, thank you for joining us on Liberty and Finance and Reluctant Preppers. We'd love to have you back on again as we go through this crazy second half of 2020, hopefully coming out with our skins intact. So thank you for being with us.
Thank you for asking me.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.